Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
And welcome back, everyone, to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ. Good morning, AJ. How are you?
Hey, Cyprian, I'm doing well. Hey, everybody out there.
Today is March 25th, 2022. The end of the month is upon us, and I feel like we're kind of just stalling in this pattern of what's going to happen next on the market front, on the geoeconomic front. What are your thoughts? What are you seeing, AJ?
Well, first thing first, we had Jerome Powell talking to us about a week ago, telling us that he may be aggressive, he may not be aggressive. This was just something picked up he was speaking, I believe, to a university crowd, and all the investors poked their ears up. If he needs to do a 50% rate hike point. So Fed's getting aggressive and making sure everybody knows it, from university students to, Wall Street. So Wall Street's taking note and they're wondering what's going on. But, I don't envy the Fed's job, because none of these variables, whether it be the price of oil or whether it be this conflict in the Ukraine, is measurable, and it's so difficult to bring the economy in for a soft landing with these variables. If it was just like rising inflation because of a slight change of supply and demand in the economy, that would be one thing, but this is just shenanigans. So they have to be very nimble. I don't know how they're going to do that, but I think Wall Street's going to tell them if they overcorrect or not.
Yeah, and so we have this waiting period on the Fed side, but it seems like this week oil is down due to some of the natural resource chatter that's been taking place, and that's leading to the market kind of being up a little bit, but it's kind of flat. So I think at this point we usually like to look at the S&P, or it looks like you're pulling up the VIX, but
I'm
what
pulling
is
up
the
the
market
VIX.
telling us? Yeah, what is the
Right.
market telling us?
I'm pulling up the VIX. Let me switch over to candle bars, because I know they're so much easier for our observers, our followers to pay attention to. So the VIX is a measurement of how much uncertainty or fear there is in the market. And you can see in the last 2 weeks, it's subsided significantly. It's come down from like $32, $34, where it was hovering for quite some time. It's back down to about $21. That's still high. When we're in a nice, comfortable market, it's down under 15, or at about 15. It's still high, but it has come down. So people, from an economic perspective, investors, I should say, are feeling a little bit more comfortable. When we take a look at the S&P 500, and I think that is always kind of a temporary thing. I love my retracement analysis. I stand by my retracement analysis. And my retracement analysis is still telling me that I need to be looking at 4,600 on the S&P 500 to be able to think of any sort of change. And even if I get to 4,600, that's only telling me that the market is clearly not in a downtrend, but it isn't telling me that I'm in an uptrend until I get above maybe this level right here, about 4,700. At 4,700, if I have this current move get up there, I can now adjust things. But until I get there, and especially if I start to see price miss that 4,600 and start to come back down, I'm more confident that I'm actually just testing the downtrend. So it's a wait and see game, but in the meantime, I'm trading the markets as if it's either a neutral market or a bearish market. I'm definitely not doing any sort of bull moves right now, unless I've got an individual symbol marching to the beat of its own drum.
Yeah, so we're definitely going to keep an eye on that over the next, I don't know, 2 3 weeks to see what happens off that level. I feel like is a fair time frame. What else do we have in the news? Let's see. China's stocks are up really high, and crypto is been making moves this week. You got any thoughts on any of those topics?
Well, so what you've just identified is two risk classes that, I mean, two of the more riskier investments, at least in the eyes of the investor. And so that means that people again are feeling comfortable of taking their money out of the jars that they buried in their backyard or out of the zipper in their mattress and putting it back into the markets when we start to see money moving over to these more riskier investments. And in addition, uh, a lot of people don't, you hear this from the talking heads on like the financial channels like Bloomberg and CNBC about the yield curves. So the yield curves are the curve of what the risk-free interest rate is set by the Fed, and also the interest rate by the 10-year Treasury bond, which is, that's set by supply and demand for that particular bond. And when they talk about the inverting yield curves, in theory, if the world is working right, you should, if you decide to put your money into an investment that's going to be, lock it up for 10 years, you should make more returns than if you put your money in something that's going to only be like a couple of months. That's the theory. But when you have an inverted yield curve, what that's telling you is the short term investment is paying you more than the long-term investment. And we're not at an inverted yield curve, but boy, these two lines are running right past each other, which means nobody wants to invest long term into these 10-year treasury bonds. So why is that 10-year treasury bond so low? Well, it's because probably all the we talked about the quantitative easing going on. So when the Fed is buying bonds, they're buying these very secure bonds. And so that automatically creates a demand for those low risk bonds, and that drops their return because, if you've got a lot of buying, there's not going to be a lot of return in that investment. We know that the Fed is probably slowing down their purchases, and yet that curve on that 10-year bond has not raised. And so what's up? It probably has a lot to do with foreign money looking for safe investments in the world. With all the shenanigans going on, there's a lot of money going into those foreign bonds, suppressing the yield, and making it so that we're having an issue, especially as the Fed raises the interest rate on the overnight lending rate and makes those short-term bonds go higher and the long-term bond isn't. That's a dangerous area. Uh, and what we're seeing from that is, of course, people have this money. They're not investing it in long-term investments because they're not paying diddly squat. And so they're looking for things like these China stocks and these even crypto, which still is considered a fairly risky investment, even considering equities. So that's what I'm thinking. I'm thinking that we've got this problem where long-term safe investments are paying nothing. And I think the Fed is trying so hard to get that yield curve off. But like I said, there's some forces against us. Namely, there's some uncertainty in the world. And it just so happens that U.S. Treasury bonds happen to be the safest place to put your money. So, yeah, there's a lot of money floating around, and when safe investments aren't paying, people start going towards more risky things. I am watching a couple of China stocks. I'm watching Alibaba. I'm watching Neo. These two stocks in general, they did pop up a little bit, but it seems they're also flattening. So I'm wondering if the whole China stock is just temporary, because the issues that people have with the Chinese stocks haven't gone away, China in general.
Yeah, exactly. And that's the greatest risk for any of those China plays is the government might just come in and say, "Hey, you guys can't do business anymore." And I mean, that's
Uh,
not a good look for an investment.
yeah, Jack Ma, remember how outspoken he was? He was like the capitalist in China. He's the guy behind Alibaba, and they slapped him down. We haven't heard much from him recently. I think he had a couple of black helicopters land on his front lawn and tell him to keep it quiet, stop talking against the government.
Yeah, it's one of those things where you appreciate the American approach of free speech. Like at the end of the day, you can say what you want, but doing business in America is definitely easier. All right, so let's keep it going. Um, we have a slow week in terms of news, kind of in a holding pattern. But
Hey, I
we
got a
did.
question for you before we get going any further. What is the metaverse? You're younger, you know these things. What are they? So when I keep hearing about Facebook and the metaverse and the Microsoft and the metaverse, how is that different than the internet?
So, it's a virtual world essentially, right? So, like, how you enter that virtual world has different shapes, right?
Mm,
Like, you can do it on your phone, which kind of takes you like one of the metaverse is a generic term,
okay.
right? For these virtual worlds, and Facebook happens to have one of them called the metaverse. And so, when you purchase one of their Oculus headsets, that basically grants you access into the metaverse, which is virtual world where you use locations and you wander, right? There's addresses and you can go into stores and there's things that are going on in those places that allow
Uh,
you to interact.
okay, so I can set my e-commerce store up in the metaverse, and then people could come visit me in this virtual world using either their something as simple as their phone or even more complex and immersive as their headsets.
Correct. And Sandbox is another one of the up and coming metaverses. And what's interesting is some of them are tied to cryptocurrency. So Sandbox is a coin that had a huge pop when this metaverse news came out because you have to use the coin to interact in the world to purchase things, right? So it begins to have a real value. Um,
And I was reading that the Microsoft Play, on Activision had a lot to do with, like, the fact that they've already got with Teams, I guess they can have this metaverse type experience where you can be, working with your team in the metaverse, like, actually doing work and not just, like, shopping or playing gaming. Is that am I on to something
Yeah,
or
if you've ever seen the movie Real Player One, right? The Spielberg, like
Yeah,
we're
yeah.
at the very initial phases of that, and that is essentially the metaverse.
Okay.
Uh,
Yeah, I think that our viewers should keep an eye on this, metaverse discussion.
totally. And maybe we should invest in some headsets to do a little of our own metaverse hanging out or something.
Well, and, many of you guys know that, we've done a couple of shows with Paul. Paul is big into that. He's in interacting with stock charts and interacting with other investors in the metaverse, and he's always talking about that. So, yeah, maybe that's a next step for us.
One last thing on the metaverse and like Snoop Dogg the rapper, right? So
Yeah.
one of the cool things that they do to generate demand is they'll have like concerts in the metaverse. And so the
Oh
only
my
way
gosh.
that you can get there is through the metaverse and there being a paywall to actually pay to go see. So kind of interesting concept.
Oh, wow. Hmm. Yeah,
Uh all right,
interesting.
cool. So let's keep rocking and rolling.
Yep.
We've got a ticker that we've been discussing for a number of shows, and I don't know if we talked about it last week or the week before. You put a position on,
Mhm.
and you're seeing a really good setup. So we're gonna go ahead and revisit our favorite fast food chain, Wendy's.
Yeah, and the reason why, when we first put our position on this, we went with a substitute option. instead of using the stock itself. And there's a couple of reasons. Now, if I was to have, so I went in with a back month put option. And that back month put option is a substitute for shorting the stocks. One of the reasons why I didn't want to short Wendy's as a stock is because of this dividend. Now, a lot of people, they know that if you own the stock and the dividend comes, then you get to keep that money. That's what owning the stock, the company pays you for investing in them. They give you some profit sharing, basically. A lot of people don't realize that if you short the stock, that you owe the dividend to your broker because they let you borrow the stock and sell it. And so while the stock was in your ownership or the obligation to return it, they want their dividend. And so when a dividend is released on a stock that you've shorted, your account gets debited for that dividend amount. You'll see a line item and your portfolio goes down. So one of the nice things about using substitute options is that whole dividend, the option is not dealt with until its expiration date. So we have an option out in 2023. So we didn't have to worry about having, we could basically take advantage of the downward move of the stock and not have to worry about, getting dinged for this dividend that came out. So we went ahead and coming back to my analysis on retracements and reversals, just a quick little tip here. So if you go to a line on close chart, if you're a charting kind of technical person, and you throw in something like I like to use just the 3 and 5 day simple moving average crossings. And I like to make it simple on my eyes to be able to know what I'm looking at. So I actually programmed one of the indicators in order to show me a 3 and 5 day simple moving average crossing, or moving average crossing in this case, down here instead of on the chart. What you're seeing here, let me remove this other study. What you're seeing here is if I took the 5 day simple moving average and I flattened out and the 3 day came along with it. So I can see very clearly where I got a crossing. And I can also see where I didn't get a crossing, where it kind of tested it for like a day, but I didn't get a crossing. So what I like to do is I take my 3 and 5 day simple moving average and I actually identify where there's a crossing, not where there's like a shallow test or a 1 day test, but an actual crossing. And I identify these moments because the 3 and 5 day crossing is a lagging indicator. And so what I do is I identify a couple of these things as I go back in time, as you're seeing me do on my chart. And then I know, because this is a lagging indicator, that between those 3 and 5 day crossings are going to be the top and bottom reversals I should be paying the most attention to. So for instance, between these two lines, I can see that I've got a low, and this is my bottom reversal. And between these two lines, I've got a high right here. This is my high reversal. So when I'm looking for where to look for my retracements, this is where I'm at, right? I've got this one, and then I've got this one, and then past here, I've got this one. And so when I'm looking at how well my stock has retraced to help me identify trend, I can use these points. And so that's a little tip. If you're looking and you're wondering, should I pay attention to all these other points in between? These are the significant points that count as reversals. So the one thing to notice is back here, we were in a little bit of an uptrend, and we turned to being in a downtrend when this particular move didn't retrace the right amount. When this right here didn't retrace the right amount to go higher, I could actually backtrack and realize that my new downtrend started on this date. It didn't start on this date or this date. It actually started back here on January 7th. And that's nice to know because I can draw myself a best fit trend line from January 7th to today, and I can understand where the channel is because then I can draw some parallel lines, find where the most tests of resistance are, the most tests of support are, and now I have a very accurate channel in which this symbol is trading in. And this tells me clearly, without any doubt, that this symbol is in a slight downtrend. So what I did back in the day, if you guys remember, is I went ahead and bought one of those back month put options. And I did that instead of shorting the stock again, so I didn't have to deal with paying back dividends. And since then, I have been, every time I get to the bottom of this descending channel, I've been buying some or selling some put protection and buying some call protection. And I leave that in place until the symbol starts going my way again. So going my way means every time it's going down. Every time the symbol is going down, it's going my way, right? Because I initially set up this trade with put options. The puts profit whenever the symbol moves down. The symbol is going against me when it moves up. And so, great. I went ahead here and I sold my premium and bought my protection, sold my protection back, allowed that premium to expire, did it again. And just this March 18th, a couple days ago, last Friday, I should say, my premium expired worthless. And now I'm looking for the next opportunity to sell the next put premium and buy the next protective option. And a lot of people ask, they say, man, you keep telling us every show that we should sell our premium near term and we should buy our protection 3 to 6 months out. Well, they always ask me, what's your thoughts on that? Why are you doing that? Well, the near term option is going to give us the best bang for our buck for selling an option. We sell this option, and because time passes by, it's going to go to zero as quickly as possible. So we're going to be selling high and buying back low or letting it expire worthless. You can't get lower than zero. So that's why we do near term. We do 3 to 6 months out because these 3 to 6 month out options are basically inoculated or vaccinated against time passing by. Time passing by on a 6 month out option is going to hardly affect its price, and implied volatility changes rarely affect an option that is that far out. So those are two reasons to do that. But yeah, it does get expensive. What's nice is when I sell this premium down here, sell this put option that's going to expire in just a few weeks, that put premium offsets the cost of the protective option. So that helps. But also, when the protective option is no longer in need, because I buy the protective option down here when my symbol is at a time of peace, and I sell it up here. So look at that. I'm actually letting that protective option appreciate in value before I roll it out. So a lot of people are saying, aren't you paying big bucks for that protective option? The answer to that question is yes, I am. But at the same time, some of that big bucks is being offset by selling my premium. So it's not as expensive as a purchase as you're making it out to be. And you guys are forgetting that by using an option that's 3 to 6 months out, every time I roll this sucker out, I make a big payday. You guys are thinking traditional protective options where the protective option is going to wind up just expire. In other words, it's a lost expense. That's not the case in the way we do it. We actually roll these protective options out for more profit than we paid for them. So not only are they acting as protection, but they are also a profit center. So we're not doing anything unusual here. You're just missing the point that our protective option is a profit center to the economics of our trade, not a loss center like a traditional protective option is.
Yeah, and Wendy's is one of those stocks that we really like because of its price. It's in that low 20 area, which makes it really nice to use these options to your advantage.
Yeah, Wendy's has the liquidity, which means you can buy and sell the options, and there's people to, sell and buy them to and from you. And then at the same price, it's affordable.
Yeah, cool. So anyone that's watching for the first time, feel free to drop some questions into the chat. If you're interested in learning more about Trading Trainer and some of AJ's strategies, we do have a daily workshop that anyone can attend. So if you haven't gone and checked that out, we're going to go ahead and drop the link in the chat, and we're going to play our nifty little commercial here to entice you to check it out. And then we'll go through some of this week's ticker questions. And as I mentioned, if you have any of your own, feel free to drop them in the chat. I think I see one already, so we'll go over that. So stay tuned, everyone.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. AJ is the best driver I've ever seen on these streets, for the record. All right, so let's go ahead and dig into this week's questions. We have one that's live. I don't know if you want to hit that first or if you want to go over some of the. So it looks like someone is curious about Nvidia, NVDA. I believe that's been kind of in the news this week, actually.
All right, so Nvidia Corp. So nice about Nvidia Corp. The Nvidia Corp has actually been on our professional traders watch list for quite a few years now. What's nice about Nvidia is that there is just a great amount of liquidity on it. It's gotten so much interest over the years as being a premier graphics card manufacturer, and their stock is through the roof. And it definitely got a pump from these graphics card crypto miners, right? Because those crypto miners, they need a whole bunch of graphics cards in order to mine their crypto. And so they go and they buy these chips off the rack as fast as they can be put on there oftentimes. I don't know how popular that is these days, but about 4 or 5 years ago, that was like the thing to do. And so it really, some of the push up in price for Nvidia was attributed to that. So let's look at Nvidia from the present perspective. In fact, let's take a look at Nvidia using that retracement or reversal kind of study that we just did on Wendy's. So I'm going to do the same thing. I went to a line on close chart and to identify here where we've got some crossings of the 3 and 5 day EMA, which is what we use a lot of times for our signals. So again, these are just little 1-day tests. The actual crossing comes here. I would even consider this move here, since it's so shallow, a test. The real crossing from top came here, maybe comes here. And you could keep going back as far as you want. But what I'm going to do now is I'm going to identify what my lowest low is. So like, for instance, there's one here, and then my highest high. And these are the closing prices, lowest low, highest high, and then so on and so forth. And then you can look at your retracement. So if I connect this line here, and then this line here, and then this line here, we were in a downtrend, but check this out. This is where one of those cases, like with the broad market, Nvidia is giving us a signal. If I connect, let me go ahead and make it so that my software here connects me automatically or snaps to those prices. If I click here to here, you can see with these current closing price that I've already not only gone past that 100% line right here. That tells me that, hey, Nvidia is done doing the downtrend, but I've already topped with yesterday's close. I've topped this 279.74. In fact, yesterday's close came in at 281.50. So that tells me that, hey, Nvidia is ready to start trending up again. Now, I always worry about the first, range expansion and range contraction in a new trend direction. That is the most fragile. But if we see a little bit of a pullback to the center zone here, somewhere between 246 to 225, and then a move up again, man, Nvidia is set to kind of, retake its bullish movements. With all that said, in the meantime, while I'm waiting for something like that to happen, in other words, I want to wait and see a pullback and then another race for the ceiling. While I'm waiting to prove to me that it truly is in an uptrend, what I could be thinking about is selling premium against this thing. In other words, Nvidia has already established that it's on a move now. So it's a little bit late for me to buy any more of this stock, but assuming that Nvidia is on its next ride, I'd be watching Nvidia for a pullback. And once that pullback is done and it's starting to head up as close as I can between finding that sweet spot behind, am I at a bottom and am I on my way back up, versus am I at a bottom that may be a false bottom and it has a little bit more to go. So that's where we use our lagging indicators. This would be my buy signal. So I would be thinking about either buying Nvidia stock, or I would think about buying some substitute options. So if I'm buying the stock, I'm okay with that, especially if I happen to be holding the stock when dividends are out there. But I could also find, like we said, Nvidia has a lot of liquidity in the options chain. I could find a cheaper substitute option, find an option probably close to trading at parity or trading at parity that'll act like Nvidia, move dollar for dollar with Nvidia, but cost a lot less. Still, I want to analyze now if I'm using that substitute option, there's going to be leverage in that option. So I want to make sure I always plan in advance what my max loss could be, set some sort of strategy, whether it be a conditional trade or a stop loss trade or even a protective option. I'd probably go with the stop loss at first, in order and calculate what my max loss, max risk is, and adjust my position size accordingly. I don't want to overextend in this. Allow Nvidia to run as far as it wants to. And when Nvidia tires and starts to test again, or if it doesn't even get that far, if it tires without proving that it's in a trend, that's when I can start selling my premium and buying my protection and start that cycle of collecting incomes. So I'd watch Nvidia. I don't think you want to short Nvidia right now, even though it looks like it might be forming a top. I would hold off on shorting Nvidia or buying a back month deep in the money put. I would actually wait for Nvidia to pull back, see where it pulls back, and if it pulls back above about $215, if it pulls back and starts going up above 215, that would be my buy signal. Now, as Sip mentioned when we were talking about Wendy's is inexpensive. Nvidia is not inexpensive. Nvidia is expensive. If you're going to be doing options trading on this, realize everything is in lots of 100. That means if you buy 100 shares of stock at $240, that's $24,000 that you need to come up with for the minimum purchase. If you buy a leveraged option, you'll pay less than that. You could pay probably for nice option trading at parity, probably half or maybe a third of the price, but that's still $8,000. And you don't want that to be the only trade in your portfolio. Again, you want to size your positions accordingly based on the risk that you might take on. And you'll be taking on much more risk if you leverage Nvidia with a call option. So size your positions appropriately. But I could foresee just looking at a typical stop loss order I would put on a $240. Maybe I'd put my stop loss at 210. And so just pulling up my calculator just very quickly, I'd be opening myself up to probably a $30 loss per share if the position completely went against me. So $30 loss on a $240 investment. Let's see, my calc coming up. I can't do this math in my head anymore. I'm getting old. So a $30 loss on a $240 investment is about a 12.5% loss. Me personally, I don't like to open my position, my portfolio to any more than about a 2% loss. So if you think about that, 2% loss divided by 12.5% loss, I should only use 16% of my portfolio. So again, coming back to just the math, if this minimum portfolio size is $24,000 and I want that to be only 16% of my portfolio, I'm going to be needing a portfolio that's 150 grand. So this Nvidia trade is for somebody who's got a bigger portfolio. It really is. And I'd be really worried. I've been working with a couple of people now who have overextended themselves into just a few positions. Make sure if you're going to be doing any sort of investing that you analyze before you get in there. You want to plan your trade. And so plan your trade means understand where is your bailout? Where will you get out of this trade and just take the knocks on the head? Understand what that max loss is, and then compare that to your portfolio of how much of your portfolio you think it's worth losing in any one given trade. And make sure you size your position accordingly so that if that position bombs out, you're not, losing half of your portfolio. Like I said, for me, I like to keep my portfolio losses on any one trade less than 2%. That means I'd have to bomb out on 50 freaking trades in a row to go broke. And I know that if I've bombed out on 3 trades in a row, I need to take a break because my trading is off. So it protects you. You shouldn't have your whole portfolio into like 3 positions that if any one of them lost, you'd lose half your portfolio, your wife, your kids, and your house. That doesn't make sense.
Yeah, we don't want that. And I agree with you. I probably would avoid being short Nvidia for the fundamental facts that their product is so in demand across the world for the things that they build. So, very solid company.
I have to say, I've had my name on a list for a 3090 graphics card for over a year now. So I know what you're saying.
The demand is there. All right, let's keep rocking and rolling with some of these questions. This one coming in from Thomas in Dallas, and he wants to know about UAL. Is that United Airlines?
That's United Airlines. So, okay, all the airlines, by the way, are some of my favorite to sell premium at. And so premium selling, let me just put this out there. Premium selling is a optimized option strategy that really works for something going sideways. So if you have a symbol that's going sideways, you're going to make the biggest monthly kind of returns, both in selling premium and rolling out that protective option, like we talked about earlier on Wendy's. if your symbol is trending, that doesn't mean you can't sell premium on it. You can sell premium on anything. It just means that probably your monthly cyclical income is going to be less, but your initial position that you're selling premium on is going to appreciate. And so you're going to make back end money. So I just want to clarify that you can sell premium on anything. It's optimized to give you the best monthly, or cyclical, because some people sell weekly options, the best cyclical returns, but you probably won't make any money on the back end because that initial purchase, if the symbol goes sideways, doesn't really appreciate or depreciate by the end of the trade. Whereas if you have something that's trending, that initial purchase will make money on the back end because while you're selling premium against it, it's also appreciating. So there's always a balance in the market. You can never get something for free. United Airlines and all the airlines are these symbols that really like to go sideways. And so if you're looking to create some sort of weekly or monthly or whenever options expire income, as you can see here, I'm showing you a year-long chart on United. I mean, even it goes sideways, and then maybe for 1 month it does a step function decrease or something, or a step function increase, and then it just starts going sideways again. So I like United. The price is not too expensive. Compared to like Nvidia, we're down to $45 a share. There's some other airlines out there, by the way, that you could buy even cheaper. But I think United Airlines is one of those symbols that just came off of a low. And this is an unusual low for us. Usually when we go that low, we start to worry about the stock, but it did wind up bouncing back. So it kind of beat the odds. When I'm talking about the odds, I'm talking about, for instance, when I set up what my channel looks like. So my channel might look like something with resistance here and support here. Generally, if I see an underlying symbol dip 2 fib lines below or above where support and resistance is, I kind of write it off, because statistically the chance of it actually reversing and coming back into the channel becomes very low. But United did it. And so this is, for me, an opportunity to go ahead and either buy some United stock in lots of 100 shares, or it's an opportunity for me to buy some back month calls. The other nice thing about United, kind of similar to Nvidia, if we look at the options chain, United has lots and lots of liquidity. You can see there's options and there's thousands of open contracts of interest. I like to envision or fantasize that the options market is like a flea market, because you got to remember, we, as the option traders, create the liquidity. It's not like stocks where it's the companies who release a set number of shares to buy and sell. Instead, we're the ones who write the contracts. So I like to fantasize when I'm thinking about the options market. I think of it as a flea market that the event company, known as the Options Industry Council, comes and sets up this big tent called the options market, and they put tables within the tent that each one is an option. And it's us who comes to the different tables to buy and sell that particular option. So sometimes when you're in this flea market, you'll go to a table, like if we come over here on some of the deep in the money options, like this particular table for the September 16th, 2022 expiration date, 19 strike price, there's only 2 people at the table. Or there might even be just one person and he's got 2 of these contracts in his hand. So that's the type of table you'd go to, and there wouldn't be a lot of activity. There wouldn't be a lot of buying and selling because there's only 2 contracts in circulation. Yes, the table was set up by the event coordinator, but we're the ones who decide how much activity is going to be there, and there's nobody at that table. There's like 2 contracts. Whereas when I come over here to the at the money option that has 1,800, I go to the table and there's like buyers and sellers. There's standing room only around that table, and people are buying and selling. And if you were to raise your contract and say, I'd like to sell these, there'll be somebody to buy it, versus at that other table where there's only like one guy. He'd raise it and he'd be like, yeah, I'm not willing to pay that price. And you don't have any kind of like market. So you always have to think about that, the liquidity of that particular option you're thinking of buying and selling when you're thinking about options. That's like an added complexity on options that you don't have to think about on stocks. But still, even with that little nuance of having to do that extra check, because you can make so much more returns on options, that's a little like nuisance that we deal with as option traders, and soon it becomes, automatic. All to say, I think you're on the right track. I actually think that we're in a buying opportunity right now for buying shares of United Airline. And then, like I said, we wait until it's a little bit higher in price. And once it gets higher in price, and my kind of idea behind when to know is I like it to get above the center of the channel that I'm looking at. And then wherever it starts to reverse, whether it reverses up here, whether it reverses down here, wherever it starts to reverse, that's where I'm going to go ahead and sell some calls, near-term calls, and use that money to offset the cost of buying some 3 to 6 month out protective puts. And I'll keep those positions in place until either this near-term option expires worthless, or until I bottom out and start going up again. If I bottom out and start going up again, this is my opportunity where I roll my protective option out, cash it in, and make even more profit. Again, I always turn my protective options into profit centers, not loss centers. And that's kind of the unique special sauce of our program here at Trading Trainer.
Yeah, and we're definitely big fans of the airlines, and we keep them on the radar pretty consistently. So thank you, Thomas from Dallas, for that one. Moving on, our next question is from Sherry in Reno, and she is curious about Bank of America, ticker symbol BAC. I feel like this is one that we haven't really covered much.
Yeah. In addition to airlines, another sector of boring stocks that you should be thinking about selling premium again is the financial sectors. Now, a lot of the financial companies are expensive, like Goldman Sachs is one we featured a couple of shows ago. But Bank of America is in that price range where a lot of us can afford it. Again, I bring it back to if we're going to do any sort of option trading against it, we have to do everything in lots of 100. So the minimum purchase here, instead of being $24,000, is going to be $4,000. So 4,300, 4,400. So it's more affordable for us with smaller portfolios. Same thing that we saw with United Airlines, where I was just about ready to write Bank of America off. It's back now in the channel, giving us a buying opportunity. And so I agree. This was Sherry, I think, from Reno. Sherry, I think that you've identified a good symbol that is trending sideways that would be worthwhile to go long on, or you can wait, and when it tops out, you can go short on it. Again, if I'm going long because it's a neutral position, I'm going to start collecting those incomes on it. I can be happy to know that the dividend would work in my behalf every 3 months. If I go short on this symbol, realize that that's a pretty healthy dividend that Bank of America gives, and that's something that's going to negatively affect your account. So if you're thinking of going short, why not instead use a substitute option? The substitute option is not going to be affected by dividends, either in the call or the put side. So something to think about. One of the things we like to do, SIP, is on our trade, we try to see if we can get everything firing in our direction. So we like to evaluate how dividends are going to be affecting us. And if they're going to affect us positively, we'll do the trade one way. If they're going to affect us negatively, we'll do the trade another way so that we can, take care of that. Same thing with trend direction. like we were talking about with Wendy's. If there is a trend direction, we want that back month or that, initial position, that covering position, to be able to be set up in a way that in the long term it's going to profit us. And we knocked it out of the ballpark on Wendy's. And then we also like to think about things like the time decay and the 3 to 6 months out to reverse time decay. So if you're selling an option, you want time decay to work for you. If you're buying an option, you don't want the time decay to be in effect because it's going to work against you. So we kind of make sure that everything is working for us. One of the newbie mistakes that I've noticed is that some people will get into a trade and they'll have a few of the variables working against us, getting against them that they didn't evaluate. And so they're like, well, this one variable that I based this whole trade on is working for me, but my option position is working against me. What's up? And the answer is you didn't really evaluate all the different aspects of what you're doing. And there's ways through option selection to pick the right option. So in my case for Sherry, I'd either buy 100 shares of this stock or lots of 100 of this stock, or I would consider a option. Let's look at the options and let's pick an option that we would use as a substitute.
I have a quick question on this one, AJ. What with the interest rate, with the forecasted interest rate hikes, how does that play into the financials and the banks?
That could the banks make very similar to the oil companies, right? The oil companies make a certain percentage of profit above and beyond the price of oil, right? And so when the price of oil is higher, their profit, even if they don't change that profit margin, the profit, because it's a percentage, is higher. And so the oil companies do better. Same thing with banks. They have a certain amount of profit margin that they put on their transactions. So great. What's neat is when the Fed raises the interest rate, their profit margin is now, it's like raising the price of oil. They're raising the price of money. And so we should see that banks do better. They've got a lot more. So since the banks have been operating in this like zero interest rate world for so long, the banks have figured out other ways to get money. And so I'm not sure that they're as tied as they once were to making money on interest. They've got other ways that they've been bringing in income, but I bet you they'd go back. I think we'll probably see more loan originations at these higher interest rates, and that could affect the banks. But I think that's going to be a lagging thing. So even if the Fed spends all 2022 raising interest rates to 2.5%, I think is where they've targeted it so far. I'm not sure that's going to affect the bottom. In other words, I think that our banks will probably still be going sideways. The interest rates have to get up at 4% or something for us to actually see the earnings of banks start to be higher and see more interest. In other words, not have our banks be boring stocks anymore.
Right.
That's a great question, though. But let's look at a back month option. Now, I want an option that's going to pretty much be trading similar to the underlying symbols. So that means going deep in the money. So I might look at an option out. This is the LEAP that's going to be expiring in January of 2023. And I might want to pick an option. The mark price is the price at which we think that a transaction would go through. It's halfway between bid and ask. And so what I want to do is I want to understand approximately how much of the value of the option that would be at expiration is part of that price. And so that's simply a little bit of a division equation. And this is, by the way, for you Greek followers, this is their way to do it, in my opinion, than following delta. some people will say, just buy a delta over 90. I think this is a little bit more accurate. So all I'm going to do is take this intrinsic price and divide it by the mark price. And I want it to be 95% or higher. So in this case, $20.80 divided by $21.05. And so this is 98%. So this is a good option. I could probably even get one cheaper if I was to look at this one here, 1880 divided by 1940. 1880 divided by 1940. That one's still above 95%. So I could use this $25 strike price option. Instead of paying $43 a share, I could paying $19 a share, so less than half. And this thing is going to basically behave exactly like the stock. In other words, if the stock goes up $1, this option is going to go up $1. And so I would probably think about using that option. Now, because I've got such a link between this option and the underlying gold price, I've gone so deep in the money. You might be asking, why do I have to go out that far in time? Why do I have to go all the way out to January 20th? It's because you want to have as many months as possible to sell that premium, make that income off of that back month option before it expires. If you make yourself a nice money machine that every month you're able to collect premiums by selling the premium and rolling out the option, you should take it as many times as you can before the back month option expires. Stocks don't expire, so you do it as many times as you want on the stock. The back month option does expire, so why not give yourself some time? I usually tell my program participants to at least go out 8 months, have the ability to at least do 8 income trades on this before it disappears through expiration.
Awesome. Always appreciate the question. Thank you, Sherry, for that one. And as always, if you haven't checked out AJ's workshop, the link is in the chat. We're broadcasting that every single day. In addition, if you're watching for the first time, feel free to hit that smash or like or follow button. We appreciate all
the metaverse.
In the metaverse, maybe soon. We'll definitely get a look into it. And with that, we're heading into the last week of the month. Basically, anything that you have that you got your eye on for the rest of the week that the audience should be aware of, tips, advice going into next week, AJ.
Well, I told you guys a couple of, I think it was 2 weeks ago, that I was interested in Amazon. Amazon made that announcement that they were going to do a 20-to-1 split, which means the price of Amazon stock is going to become something of, right now it's trading up around $3,250. We're talking about it getting divided by 20. So I've been looking at this to see when is the perfect buy time. And I just want to let everybody know Amazon is basically kind of stalled. And it's in this point where every one of my indications of trend, whether it be my tried and true reversal analysis, or whether it be just looking at things like where is price with respect to the 200-day simple moving average, or what direction is our 30 and 40. These are some of the techniques we use to determine trend for our swing trading templates. They're all coming up inconclusive, meaning that Amazon hasn't quite bit the bullet as to whether it's going to start uptrending or not. So I'm a little bit hesitant to recommend buying my Amazon yet. Even, and it hasn't dropped in price yet. I think that's going to be a June. I think they scheduled the reverse split to go, or the split to go in to effect in the beginning of June. So we've got some time, but I really want to see Amazon pick a personality, right? Stop being in limbo. Be bullish, be bearish, or sideways channel, but don't just stall out in this kind of like, I can't tell whether you're a boy or a girl right now. So that's what I'm going to be watching this upcoming week, to see if Amazon differentiates itself and tells us whether it's ready to go higher or ready to go lower. So that's really where I've been focusing on things like that, and on things like just making sure that people are taking on the right amount of risk and not overextending their portfolios.
Totally. So we'll keep an eye on Amazon next week. We'll keep our ears in tune with what's going on with the war in Ukraine. We'd like to, send our condolences and our
Always.
thoughts to anybody that, that's being affected by that. We've gone ahead and changed our background a little bit there to show our solidarity. Other than that, feel free, everyone, to drop your questions into the chat. Send them email. Send them in an email in the DM. We'll get back to them as soon as we can. And otherwise, we hope everyone enjoys their weekend, and we'll catch you guys next week. Thanks for tuning in.
Thank you, everybody.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.